Welcome to this week's Market Matters weekly video update. It's Wednesday, the 24th of November. James, we're in the office today, getting things done as always. We're going to talk about a few things. We've written about a lot of different stocks lately across all the different portfolios and all the different reports we do each week. But we're going to nail a few on the head. Firstly, in focus, we bought this stock yesterday. It rallied throughout the day. It's been supported again today. It's Fortescue Metals, FMG. James, take it away.
Yeah, well, iron ore has been on the nose clearly over the last 6 months. Really, it's dropped from above 200 a ton down to sub 100 a ton. Got down to around the $90 mark. The consensus out there is very bearish on iron ore. It's bearish on iron ore because of the slowdown in growth in China, particularly being driven by the slowdown in the property space over in China. And obviously that's having a flow-on impact to demand for iron ore and therefore pricing of iron ore. I think it's, one of the things that I'm really conscious of is market positioning. And one of the things that was really noticeable was the bearish positioning around iron ore from a market's point of view. So it only took one slightly positive update, and that was Chinese authorities putting pressure on banks to lend more to support their property market, to see a big rally in the iron ore price, and that saw a big rally yesterday in Fortescue. I didn't think yesterday would be up 10%. So we struggled to buy it throughout the day. We continued to buy it throughout the day, I think given where it's come from and where it's got to, buying it up, 5, 6, 7% on the day is okay. I think it'll go higher from here. So it's not a position we're going to be married to, but from our, the flagship growth portfolio now owns 5% in Fortescue. I think it goes higher from here. I think there's a real chance that iron ore in the next couple of weeks could be 120 a ton, and then we'll see, Fortescue being 20% above where it's trading at now. So not a longer term play, a shorter term play for our growth portfolio, but one I think looks good. Really, looks good here.
Yeah, definitely. Around the Fortescue trade, we had to sell something. We're pretty tight cash in the growth portfolio at the moment. So we sold AGL, nickel and lithium. Is that a pairs trade? Are we now short lithium, or is it just more we prefer to be in iron ore here?
I think you've got to, if you think about the bigger picture, we want to be adhering to our view that commodities are cyclical. So, the lithium nickel prices have been really strong. Lithium in particular, I think I'm a little bit more concerned about the lithium price where it is at this current point in time. IGO reached our target. We're selling strength, buying weakness. I've learned over the years that selling resources when they look really good, look really strong, and buying them when they look pretty mediocre often pays dividends. And we saw that. I go back to 6 months ago when BHP was trading north of $50, approaching $60. We had a $60 price target. I sort of kicked myself for not taking some off the table, at least in terms of BHP. Everything was looking really solid for that. The commodity trade, everything was looking very solid for BHP in particular, and not being active around that holding. So I think that's a lesson learned. And whether or not lithium goes higher and IGO goes higher, I'm not sure. But I think the risk reward at $10.50 doesn't stack up. I think the risk reward in Fortescue, sort of $16.50, $17 stacked up. So that was the rationale for that trade.
Yeah, definitely. One stock that I think it's the stock we've talked about the most across our reports, but never owned, is Aussie Broadband, ABB. It's been strong. It's sort of consolidated, did a big raise to sort of fund some acquisitions up and coming, but it's sort of consolidated around that $5 mark. When do we pull the trigger on that one, James?
Really good question, Harry. And it's a stock, it's been a frustrating stock. It would be a stock that would go into your portfolio, the emerging companies portfolio. We have effectively chased it higher, if you like. So this is a stock we've liked for a while. We have been really cautious around the risk reward of going in and buying this thing. We probably should have. We clearly should have. Now that it's had sort of 4-5 months worth of consolidation, it did try to break out. It's come back into the range again. Around that $5, I think looks really good from a risk reward perspective. I'd like to see a bit of washout down the downside. I think there's probably a lot of complacent longs in this stock who may have bought the breakout of the consolidation range that we saw early this week, late last week. So around $5, I'd be a buyer of that. It got the 503 today. We haven't pulled the trigger yet, but that is one that's really very much will be featured in your portfolio, no doubt, in the coming weeks.
I think we've uttered those three letters a few times every day for the last couple of weeks. James, AGL, it's a stock that mirrors the AMP chart. It's gone from
that's a good omen.
Good highs to like really strong highs a couple of years ago to trade, well and truly a deep discount to its all-time highs. There, James, we spoke about it today. Is that in the too hard basket, James?
I don't think so. We've had so many questions about AGL over the last 12 months or so, and we've sort of put it in that too hard basket that it was sort of, management didn't have a handle on the business in terms of what the energy transition meant for earnings. You could see it in the guidance they were putting out. You could see it in the numerous downgrades they had, and just the management commentary. Whenever you jumped on a call with AGL, it was very uncertain. I think now it's got to a point, and why we wrote about it this morning and why we're going to buy it in our income portfolio, is it's got to a point where the energy retailing business is just too cheap. So we've seen interest overseas in these energy retailing businesses at significantly higher levels than what is implied by AGL share price. So from a deep value perspective, I think it stacks up here. It's trading around $5.30. We are going to add it into the income portfolio. I look at consensus yield as at 12%. I don't think it's going to pay that. I think over the next couple of years, its earnings are going to be choppy. But don't forget, it is the biggest. It is the biggest private provider of renewable energies in Australia. So it's not all just about dirty coal, etc. It's a deep value play, and I think if the market doesn't value it here, someone else will. So I think it offers strong yield, which is a key requirement for the income portfolio, but also there's deep value in its assets. And you mentioned AMP, Harry. We've written about it in a number of notes. You've got to, everyone's, when the market is universally negative on something like they are on AGL and AMP, these things are forced to, these things will turn around at some point. I know, people in the last 12 months may have picked a low in these stocks and be regretting it at the moment. So we're going in with small position sizing, but I think you've got to be looking for value in the market. And I think AGL is a clear example of value, and I'd throw in AMP there as well.
All right. You can't talk about stocks with us without talking about CBA in the last couple of weeks. It's had a big sort of fall from grace, nudging on that $110 mark. Gave back 10%. It is up a little bit today. James, what do we do with that stock in the portfolios?
Yeah, I think it will. If we didn't own it, we'd be buying it here. If we're traders, we'd be buying it here. We've got in our flagship growth portfolio, we've got a 5% weighting. We did trim it from at around the 106 level. In our income portfolio, we've got a 7% weighting. That in the last week, it took 70 basis points off our performance in the income portfolio. The income portfolio was up during the week, but it's still, that 70 basis points detraction from CBA was pretty big in that portfolio. So we won't be adding more to it at this point in time, because we've got, we're comfortable with our bank allocations, but if we didn't own it, we'd be buying it, would be the key message there. I think the reason for the drop around margin compression and pressure around margins, net interest margins, that goes away as interest rates track higher. So, the economic backdrop for banks remains positive. It's just this margin issue that's really hurt them in the short term, and the CBA refocus the market's attention on that margin issue. So we'd be buying if we didn't own it, Harry, is the key message.
All right, we'll wrap it up there, James. I think we've touched every quarter of the market in this chart. Lots to take away from that video.